Welcome everyone to Elliott Wave International's webinar, 5 Option Strategies Every Elliott Wave Trader Should Know. My name is Wayne Gorman and I will be your instructor throughout this entire webinar. Before we get started, let me tell you briefly about my background. I have over 25 years of experience in trading, forecasting, and portfolio management. I worked at Citibank in New York and also Westpac Banking Corporation in New York. I traded on my own for 4.5 years using my own capital, and I joined Elliott Wave International in 2002. I've been using the wave principle since 1986. In tonight's webinar, the way this is organized is I'm going to look at 5 different market situations from an Elliott Wave perspective. These are situations that are challenging. They pose certain risks and certain challenges. And for each of these situations, I'm going to discuss an option strategy which I feel is one of the best option strategies to use for that situation in order to enhance your ability to be as successful as you can in that situation in terms of your profitability. As we go through this, I'll certainly be talking about a lot of different patterns. I'll be talking about Fibonacci. And if you're interested, we certainly have other courses on each pattern. So if something strikes you and you want to learn more, we certainly have an entire library of courses on all the different patterns and Fibonacci. In terms of questions, I'm going to take all your questions at the end. So if you have a question, please write it down, and preferably even write the slide number down if you can. And I'll take your questions at the end because I want to make sure I get through all the material first. And also keep in mind that after the webinar finishes tonight, even after the Q&A is over, you can send your questions in through the Q&A form. You should have received by email a special link, and you can send questions in to me. I think it's for like a 1-year period. And if you're not sure about that, just contact customer service. And you can send your questions in, and I will answer them as soon as possible. So let's get started. There's a lot of material, and what we're going to do is go to the first scenario. First scenario, regular flat. At the top of each of these, when we go through each of these 5 situations, there'll either be a question or some remark. And in this case, this is a situation, regular flat or expanded flat. I don't know how many times I get questions about this situation where you're coming down in, let's say, wave 1. Wave A is a zigzag, let's say a three-wave structure. Then you're coming down in wave B. And the question I often get is, well, how do you know how far the B wave can go? After all, you could have an expanded flat, or you could have a regular flat, as depicted here by these dotted lines. Let's assume that you're right here. And you certainly, if you're trading outright futures and cash, there certainly is Elliott Wave guidelines that you can use. And like I said, we have courses on this. But in this situation, yeah, it's challenging. This B wave could go. There really is no limit. It could go way down in this situation. Or we could stop here and go up in C, or come down in B and then go up in C. So what we're talking about is a situation where you could have a sharp but limited move in either direction. So what do? If you're trading outright, you have that difficulty. If you decide to go short, all of a sudden the C wave goes up, you get stopped out. Maybe you go long, but no, the B wave is going down, you get stopped out, and so on. And like I said, there are ways to manage that. Well, there is an option strategy that fits this situation. like a glove, and we'll go to that right now. It's called the short iron butterfly. Short iron butterfly. And what we do in this situation is, as you can see here on the right, we buy an at-the-money call, one at-the-money call. We buy one at-the-money put. We sell an out-of-the-money call, and we sell an out-of-the-money put. What we're doing then by buying these at-the-money calls and puts is we're positioning ourselves for a move in either direction. But that's expensive. And since we know that the move is limited, this is a counter-trend move, right? This is not, we're not talking about the main trend right here. We sell further out of the monies in areas where we think is the limit of the move to gain some extra revenue to reduce our cost. Net, we still end up with a net debit. Net debit meaning it's a cost, a cash outflow. But if we structure these short iron butterflies properly, we can achieve a decent risk-reward ratio. A lot will depend on what the implied volatility is at the time that we get into the position. There are a number of variations on the short iron butterfly. We just don't have time tonight to go into them, but you've probably heard of them. You've probably heard of the word condor. There's what's called the short iron condor, very similar to the butterfly. Anytime you hear condor, what you're doing is you're, instead of being at the money, you're moving your strikes further out. It's less expensive, but then the potential returns are also less. But if you have any questions on any of the variations, there's the short put butterfly, short call, and so on, just send them into the Q&A forum, and I'll answer them for you. Here are the characteristics, what we look for here in the short iron butterfly. As I mentioned, we're buying an at-the-money call. This is all one-to-one, all ratio of one of each. We buy an at-the-money call to position for the potential sharp move up. We buy an at-the-money put to position for the sharp move down. We sell the wings, as they say, so to speak. So that's why we call it the short iron butterfly. We're going to sell an out-of-the-money call, and we're going to sell an out-of-the-money put. We're looking for a sharp but limited move in either direction. Relatively long term, we'd like to go out about 3 months. Our maximum risk is capped at the net debit. Our maximum reward is capped at the difference in the adjacent put or call strikes minus the net debit. So we have two break-evens. And when I talk about things like break-even, this is, of course, at expiration. Between the inception of the trade and expiration, it wouldn't be exactly that because you're subject to changes. You have in implied volatility, and you also have time decay. But we have an upper break-even, the long call strike plus the net debit, lower break-even, long put strike minus the net debit. And throughout this course tonight, I will assume that you have a basic knowledge of Elliott wave, and also you should also have some basic knowledge of options. So I'm not going to get into too much into the option theory. Now, optimum Elliott wave characteristics for using the short iron butterfly. Well, by definition, for the short iron butterfly, this is a counter-trend move, as we saw in the diagram. Could be wave 2, wave 4. We're looking for either an expanded flat or a regular flat, those types of situations. The position, wave position, 2 or 4 of an impulse, be of a zigzag or flat, X, Y, Z. A relatively low degree. This type of strategy is not for a big trending move. It's for these counter-trend moves. And our entry point is going to be the C wave. Within that wave, within the wave B, preferably wave B zigzag. We want favorable implied volatility. Favorable, I use the word favorable because it was tough saying high, low. It really depends. And in this case, we'd like to get in at a somewhat low implied volatility because we are buying the at-the-money options, which are expensive, and if the implied vol is high relative to recent history, that just makes it more expensive. The wave prior to entry point at next lower degree, impulse or diagonal, and always rely on Elliott wave rules and guidelines. So let's now, we're going to look at an example. This is a chart of coffee futures. This is the December 2008 futures contract. It's a daily bar chart. And we're starting out here. This chart, this last bar is August 11th, 2008. Just a few quick things on coffee. It trades in U.S. cents per pound. 1 point is 1 cent, which is $375 a contract. You'll notice throughout this coffee example, I'm rounding to the nearest 0.05 on a lot of things because the coffee futures trade and a minimum tick is 0.05. Minimum option tick is 0.01. So here it is. It's August 11th, and we're looking at this coffee chart. And let me put some wave labels on here. So I've labeled this decline 1, 2, 3, 4, 5, and I'm calling this wave 1. And now I see what seems to be a three-wave structure here, an ABC. So I'm calling this wave A of wave 2. And I'm noting the fact that the A wave is a three-wave structure. It is somewhat shallow. It doesn't really look finished. Let's do a Fibonacci retracement analysis, and we can see that this A wave over here made almost an exact 382 retracement. That high of the A is 146 even, and the 382 comes out to 146.10. I put these other retracements in here so you can just see what I'm looking at. So we can take the view that since second waves are normally sharp and make deep retracements, that this wave 2 is not over. Meaning wave 2 in blue in parenthesis that's retracing this wave 1 that I'm pointing to. We should get a deeper retracement. Well, how are we going to do that? This A wave doesn't look like a 5. It looks like a 3. And we're coming down here, and it looks like we're coming down in the B wave. Well, that means what kind of corrective structure? What corrective structure starts out with a 3 that occurs in a second wave? Can't be a triangle. Second waves are not formed by triangles. Has to be a flat. If it was a zigzag, this A wave would have a clear 5-wave structure. Well, if it's a flat, we're in that situation. Well, is it going to be a regular flat, an expanded flat? One of the scenarios is right here, an expanded flat. The B wave may come down in this area and then shoot up in wave C. Here's another possibility. The regular flat, where wave B only goes to the start of A, but then you have the C coming up, and since it's a second wave, it's very common to see that C wave go beyond A. A perfect regular flat, the C wave would end right up here, but we often see, and I see this a lot in currencies recently, that the C wave will make a deep retracement, even though the B wave only went down to the start of A. Now, of course, if we're wrong, and this was all of 2, well, we'll continue down anyway. And even if we're wrong about being a flat, well, then it would probably go up and form some type of zigzag. But right now, based on the wave structure, it seems to be we're only going to get either a regular flat or an expanded flat. Now, right here, I'm using some Fibonacci guidelines. What we want to do now, if we're going to set up the short iron butterfly, we want to estimate how far down wave B can go. And here are a couple of guidelines. We know that wave B is often equal to 1.236 that's the Fibonacci 1.236 multiple times wave A. And when we do that, that comes out to 135.68, which is down here in this area. If it goes beyond that, another guideline is that wave B will equal 1.382 times A, and that occurs right here at 134. So we have now targets for the downside of wave B. And we now want to look at, well, when wave C kicks in to the upside, what's the potential for wave C? And we go back, we look at these retracements. And a common retracement of wave 1 by wave 2 is the 0.618. That comes out to 151.30. So we're going to keep that level in mind for wave C, that wherever wave C starts, whether it's at the lower end of that B wave or at the upper end, that it will probably end somewhere in this area. So that gives us one upper target. But let's do some more Fibonacci analysis. We also know that the Fibonacci guidelines for expanded flats are that the C wave will often equal 1.618 times A, and that occurs at 149.19. Another guideline is that C could equal 0.618 times A past A. That occurs at 151.16. And as I mentioned on the last slide, wave 2 makes a 0.618 retracement of wave 1 at 151.30. So we have what we call now here a Fibonacci cluster. We have a number of points here that tell us, and again, on these calculations, what I did is I assumed that the B wave would go to about 135. Obviously, the B wave could go to any number of levels, but I had to use some estimate. So I'm assuming this scenario that the B wave comes down to 135, and that based off of that, the C wave would end up around 150, 151. So we have a number of points here. That's a Fibonacci cluster. That's going to be, our target is going to be somewhere in this area, excuse me, to the upside. But before we actually do this trade, we have to look at one more thing. We want to look at what's the implied volatility at this time back here where we're starting. And so let's look at that. This is from Bloomberg. And this is a chart of the implied volatility on coffee futures, the front contract, going back to from the beginning of the year to where we're going to start trading, which is on August 11th. And what we see here is that the vol is relatively low. If you see where it's been, we had some spikes here, but we're getting in at a decent level here. It's not too high if we just look over the past year. So that's good because we are going to be buying these at-the-money puts and calls. So let's now put the trade on. We're going to do a short iron butterfly on August 11th. And at that time, coffee was trading around the 140 level. It actually closed, I think it closed on August 11th down around 140 and change. I think it was 140.15. And what I'm trying to do here is it was trading in that 140 to 142 range. So I started to construct this. I'm buying the 142.5 calls, and again, this is all one to one, one of each, a ratio 1 to 1. I'm buying the 142.5 calls, and I'm buying the 142.5 puts. And here are the prices. The calls cost me 7.3 points. The puts cost me 10 points. The reason for that, why they're not almost the same, in going back and using historical data, I had to look at everything on a closing basis. It was difficult to get intraday option data on a historical basis. So everything's based on closing prices, And coffee, on the day we did this, coffee closed down at 140, so in a sense I was buying, my puts were in the money, about 2.5 points. You subtract that 2.5 from 10, you're at 7.5. That explains that difference. What I'm trying to do here in constructing this, looking at all these different premiums, is the key is my break-even rates. I want to make sure that I have tight break-evens so that if we get a move in either direction, it doesn't take too much for me to break even. So it's a trade-off. On these sells up here where I'm selling the calls, I'm trying to sell the calls and the puts in areas where I don't think you can go much further. So I'm not really giving up anything. Now, on the one hand, I'd like to sell my calls and puts closer in to achieve more income to reduce my cost. But then that could hurt me in terms of my break-evens. If I'm sorry, I'd like to sell them further out to help, give me extra potential. But I also have to take into account my break-evens. The further away I sell my calls and puts, I have less revenue to offset my cost of buying them at the money, and that hurts my break-even. So I got to make sure my break-evens are within the realm of the move that I'm expecting. And here are the details of this. The result of doing this structure at these prices is that I have a break-even of 148.80 to the upside and a break-even to the downside of 136.20. And that's based on all these premiums and the strikes that I'm dealing at. And that's good because I'm expecting a move up to 149.150. So I'm hoping then to do better than that break-even. And on the downside, I'm expecting at least down to 135 and maybe even 134, which goes beyond this break-even. The total net debit on this structure is 6.27%. And I'm sorry, the total net debit is 6.27 points. The implied volatility is a 30.31%, and this is on the, I'm doing the December contract, which expires on November 12th. So that gives us about 3 months, which is what we were looking for. It's probably a little longer than we need because the sharp move up or down is probably imminent, but you never know. I've seen second waves that use up a lot of time. And since we have a net debit of 6 points, almost 6.25 points, we're paying the points. Time is important. We don't want to run out of time. We rather have more time than less time. If we run out of time and the move hasn't occurred, we end up with a loss. So we want to give ourselves ample time, but we don't want to pay too much either. So a maximum risk is 6.27. A maximum reward in this case was 1.23 points. Not a great risk reward, but a lot of that had to do with these puts that we bought that were actually in the money already. You're not going to get fantastic risk rewards on these, but your chances of actually getting a reward is high because you're positioned for a move either way. Now, ideally, the ideal situation would be for one of these moves to occur right at expiration, so we don't even have to unwind anything. We just we would make our maximum number of points, which is 1.23. But we can do better than this. That maximum reward is based on just being successful in one of these legs. In other words, either catching the B wave down to 135 or the C wave up to this area, 149 to 151, basically up to 150. But what if we caught both moves? If this unwinds quickly, we can actually take advantage of both. We could get out if we get down to 135, we could cash in our puts, and then if we shoot up in wave C, cash in the calls. Again, if it all happens within this time frame. So our maximum reward is, or potential reward, is actually even greater. This just assumes making money on one leg. Now, again, this implied vol is on the December contract, not the front contract, and it's about the same as the front. So let's now we're going to move forward. Okay, we've come down, and right now we're at about 136.85. It's August 13th. We just gone a couple of days. And it looks like that B wave is going to go down and probably produce this expanded flat. We've come down further. I've moved ahead. It's now August 15th. And we're at 135.15. We've sold the 135 puts. So basically, we can't do much better at this point. Only another 15 ticks. So what we're going to do at this point is this is where we get out of the puts. We're going to cash in the puts. It would have been nicer if it took a little bit more time, but not too much time. But we know that C wave is on the horizon, is going to make a sharp move up. So we're going to get out. On August 15th, we're going to get out of the puts, but we're going to keep the calls because we're going to be positioned for that C wave, hopefully to the upside. So I've sold the 142.5 puts, and I bought back the short puts that we had. I basically closed out the put position. That was a net credit of 4.83 points. It didn't cover our entire cost. Our entire cost is 6.27 points. So we still are in the hole, but we're getting there. And what we're going to look to do now is hopefully get the C wave of the expanded flat. So let's move forward. Okay, we've shot up here. We've got up to 148.80, so we're basically breaking even on the, we reached our original break even, but of course we're actually doing better because we cashed in those puts. And I notice I left the call position up here. Here are our calls. And this is now August 26th. This unfolded a lot faster than I would have expected. But again, it's also logical for a second wave to move sharply. We're at 146. We're still going to hold because we're looking for that 150, right? We're looking to get up to 150. So move ahead. All right, now we're up to, it's August 27th, and we're up to 152.25. So now we've made our target. We've actually gone past the 150. There's nothing more to gain here. Unless it just were to move sideways, we're going to cash in the calls. And so on August 27th, I buy back the short calls. I sell my long calls. That gave me a net credit of 3.2 points. And my total net profit was 1.76 points. And that's how you do the short iron butterfly. You looked actually not just to make money on one leg, but both legs if you have enough time. And if you're just curious to see what happened after that, coffee then went down right after that C wave ended, as you see here. We're going to come back to coffee. We're going to look at coffee again on another scenario. So that's the end of this particular scenario. We're going to go on now to the next one. Again, if you have questions, just write them down, and I will cover them at the end. Second scenario. Question. Steady continuation of the main trend or choppy? Here's the situation. You have a 1, 2, 3, 4. You're going into 5 on a long-term trend. Maybe you're already long or you're thinking of going long. You think there's some more upside and you want to take advantage of it. But you're concerned. You're concerned about these possibilities that as you're in wave 5, and maybe it's going to extend, maybe you're going to get a 2 down here, maybe a 2 down here, maybe it's going to be choppy. You don't want to get stopped out. You get stopped out, you know the feeling. You miss the move, you get in, you get stopped out again, you get in again, you get stopped out. We've all been there. If you set your stop, and this, again, we're looking at a bull trend here. If you set your stop low to keep yourself in, well, then you face the possibility of a big loss if the market turns the other way. So what can we do about this? We can do what's called a collar. And what we do with the collar, this is a somewhat longer term strategy, 6 months out to a year. In this particular situation, if we're talking about an uptrend, we'll buy an out-of-the-money put. It could be, let's say we go long, maybe slightly below where we're long or further down. That's for protection. So we don't use stops in the sense of futures, a stop on a futures or cash contract. We have a put, and to finance the purchase of that put, we sell an out-of-the-money call so that it gives us room to the upside. We're willing to give up some upside. We estimate how far we think this will go. We sell a call. Now, why does this work? Well, it works in the following type of situation. If you're talking about some market that's been in a long-term trend, or a stock, an individual stock, which we're going to look at, where the fever is really strong, sometimes the revenue you get from selling that call will offset a lot of this put. And you can set this put really very close to where you were long or where you went long. So in a sense, you have this really tight stop, and since it's an option, you don't have to worry about getting shaken out. If the market goes down, you don't have to get out. You're protected. You can hold the position. So no matter how choppy or wherever the market goes, you don't get stopped out, but you can get out if you want to. And you can finance a lot of this cost through a call. Now, why does that happen? What happens is sometimes if it's so strong to the upside, you can get a really good premium on those calls, even though it's out of the money. And the puts are relatively cheap. Now, you still could end up with a net debit, which is, of course, a net cost to you. But look at the flexibility this gives you. We don't worry about getting stopped out. Your cost is low. And if you've done your Elliott wave analysis correctly and you've identified the potential, you could have a really nice risk-reward ratio for yourself. This would just be the collar. You can use the collar to the downside. If it's a collar and you're in a down market and you want to short something, you could buy an out-of-the-money call for protection and you sell an out-of-the-money put to finance it. And hopefully, if it's so bearish, you'll get so much money for that put, you'll cover a lot of the cost of the call. Sometimes it's not even a net debit. Sometimes you might even be able to break even and maybe even have a net credit. And here are the particulars. So a collar with a short position. We buy an out-of-the-money call. We're shorting the asset. We sell an out-of-the-money put, net debit. Cautiously bearish. A relatively longer-term strategy. You know, one of the catches on this is that they usually work if you go way out. Like I said, 6 months to a year. Some people go beyond a year. Your maximum risk is capped at the difference between the asset price received and the long call strike plus net debit. Maximum reward is capped at the difference between the short put strike and asset price received minus net debit. So on the short side, your asset price received minus net debit, you have this break even on the short side. And the long collar, which was that first diagram we looked at, we go long, we sell an out-of-the-money call, buy an out-of-the-money put, we have a net debit, cautiously bullish, and then it's the same particulars, the maximum risk, maximum reward, slightly different because now we're on the long side, and your break even to the upside is the price you pay plus that net debit. From an Elliott wave perspective, here are the characteristics. With the collar, we're talking about an actionary wave, the main trend. We're talking about a main trend that's been ongoing, an impulse, possibly also an ending diagonal. The ending diagonal is all zigzags back and forth, it's choppy. We're talking about a fifth wave, a relatively high degree. We would probably do it in wave 2 of 5. In terms of the volatility, that's a double-edged sword in this case, because in one sense we like it somewhat high because we want to have it spill over to that out of the money option where we're selling. We want to get a lot of revenue, but on the other hand, it could hurt us in buying that protection option. So it just depends on that situation. A wave prior to entry at next lower degree, impulse, or diagonal. So let's look at an example of how we would use the collar. Here's a chart of Google, and we're going to start this recent bar that I'm pointing to. That's September 4th, 2007. Google closed at a 525.15. And we're going to start counting from this major low down here in 2006. As you know, Google was an IPO issued August 19th, 2004. So we don't have much price history on Google at this moment in time, but we can count this from that low. And here's the count. I'm counting at 1, intermediate 1, 2. Here's a wave 3. I've shown you the subdivisions of wave 3, 1, 2, 3, 4, 5. Wave 3, and I've counted this as wave 4, and I'm counting this that we're going into wave 5 to the upside in Google. And my view here at this point in time is that there's further to go, and we're going to use some Elliott wave analysis to determine how far this can go. And the situation at this time, as you might recall, is there is a big fever around Google. It was hot. And let's assume that, okay, we want to catch this move to the upside, but we've already come a long way, and this is a $500 stock. I mean, this thing's been moving up and down about, let's say, in a range of, let's say, each day, intraday, about $15. So we need to be somewhat cautious about this. But one thing we want to do first is see, well, what's the potential to the upside? And let's use our Fibonacci guidelines. We want to identify that potential to the upside so that we can figure out a good place to sell a call to produce enough revenue to buy a put for our protection. And I'll explain again why we need that protection. But here we have, I'm looking at a common Fibonacci guideline, which is that one guideline is if wave 3 is extended, you can expect wave 5 to equal wave 1. And that's what this diagram is doing. I'm starting here, I'm measuring the length of wave 1, I'm expanding it for the end of wave 4. And at 599.63 is where wave 5 equals wave 1. Now, this third wave, you could debate whether it's extended. It's almost, it's about 1.7 times the length of wave 1. It's certainly long, and it has big subdivisions. Will it in the end turn out to be the extended wave? Not so clear. It's not as elongated as I would like, especially this subdivision. If this 1 and 2 were bigger, if this 1 was as big as that one, and if this 2 was as big as that 2, I'd feel more comfortable that this was an extension. So what am I trying to say? Well, maybe this is an extension and wave 5 will end here. But there's also a chance that wave 5 could be the extension. So we have to keep that in mind. So one of our targets based on this is 600. Based on the, this is of course the guideline, actually it's the guideline of equality where what we're looking at really here. as opposed to a Fibonacci expansion. It's really the guideline of equality, which says that if one of the waves is extended, then the two non-extended waves will tend toward equality. But let's now look at some more relationships. Okay, here is a Fibonacci expansion. Here is where I'm looking at the net distance traveled of waves 1 through 3. So I start here, I end here, I expand from 4, and what this is telling me is that if wave 5 equals 0.382 times 1 through 3, it comes out to 567. However, which doesn't help us very much. We already made a 558 high over here, and that's below what I would believe would be our minimum. I believe the minimum would be 600 based on the guideline of equality. But if wave 5 equals 0.618 times the net distance traveled of waves 1 through 3, we get 620. So we're going to keep that in mind. We're going to keep a 600 and about 621 as potential targets. Another Fibonacci guideline. Wave 4 will often, the end of wave 4 will often divide the entire price range into the golden section. The golden section is 0.618 and 0.382. These are Fibonacci ratios. Well, that would occur at 572. That doesn't help us very much. We made a 558 high here, and that's below 600. So we don't see a Fibonacci cluster there. But it does coincide with the 567 that we saw. Okay, but here's something. Another common Fibonacci relationship is that the end of wave 4 will divide the entire price range into two equal parts, 50% and 50%. What this is saying is that if wave 5 ends at 629, wave 4 will have divided the entire price range into two equal parts. So we have 629, 621, 600. What our Fibonacci guidelines and guideline of equality are telling us is that most likely Google is going to go up into that low 600 range. So now that gives us a target. We're going to go long Google, and we're going to look for something up at least at 600 and maybe as high as 629. But I want to talk about stops first. When we go long, here's the challenge, or the dilemma, depending on your perspective. If I set a tight stop up in this area here, I run the risk of getting stopped out, and maybe I miss the whole move. This stock is volatile. If I set my stop at a logical place, which might be below this wave 4, right? If I go below what I believe is wave 4, below this 480, and I'm buying at I'm going to end up buying at 525, or maybe I'm already long at 525, so we're talking opportunity cost. Well, I'm going to lose $45 a share if this thing goes down and I'm wrong. So in setting your stops, it's really difficult. If you're going outright, you might get stopped, got to get back in again. Maybe you get back in. Maybe you get stopped out and you miss the whole move. I mean, in theory, this could go, maybe wave 4 is not over. This could go below, all the way down, right in this area that I'm pointing to. And remember, the rule is wave 4 cannot end in the price territory of the wave 1. Well, wave 1 was at 450. Now, I'm not going to put my stop down at 451. I'll lose a fortune if I'm wrong. So that's the benefits of the collar. What I can do, and let me just illustrate first. Here's that where wave 1 ended here. This is a possibility which makes it difficult in terms of setting your stops when we go long. So if I do the collar, what I'm going to rely on is that the fever is strong and that hopefully I'm going to sell a call up in here where I think is the limit of the move. I'll give up. If it goes beyond that, I'll give that up. I don't care. And if it's really strongly bullish, I hope to generate enough revenue from that call to buy a put right in here, I basically create a tight stop for myself, and hopefully at a low cost. I'm going to actually try almost an at-the-money put, a 520 put for protection, just $5 below where I'm going long at 525. Before I do that, let's look at the vol. Here's a chart of the implied volatility on the front options contract on Google, and we see that we're kind of in the middle here. It's been roughly 30 to 20%. We'll be getting in around the 25.5% range. So that's okay. It's somewhat neutral. So I'm going to construct the collar, and here it is. I'm going to go long Google at 525.15. That's my long position in Google. And then I'm going to do options, and of course, one options contract is 100 shares. So the minimum then on my long position for every option contract, I got to have 100 shares. That would be the ratio. And what I'm going to do is I'm going to sell the March 2008 calls. That's almost 6 months out. The Marches expire March 22nd, 2008. Right now we're on September 4th, 2007. And I hope I keep these years straight. We have a lot of examples of different years, so I hope to keep them straight. But they're all printed on the slides correctly, so if I misstate it, you can just see it on the slide. And look what I'm going to do. I'm going to buy a 520 put. I can buy a 520 put at $32.70, and I can sell the March 600 calls at $17.10, covering more than half my cost of my put. I have really tight protection, so I have a net debit, a net cost of $15.60 per share. And my put, the closest I could get to 525 was 520. So my maximum risk is $20.75. That's the most I can lose per share. But look at my maximum reward. If this goes to 600, I can make $59.25, which is the difference between 600 and 520, which is $80. But then I have the net debit. I subtract that, and it comes out to $59.25. My break even is $540.75, which isn't bad. We're at $525. And here are my price targets. Now, of course, there's one hitch here. I don't realize this $59.25 maximum unless this all happens at expiration. If it happens in between and I got to buy the calls back, I will be somewhat less than that, but I should still have a profit. But obviously, if on March 22nd, 2008, the Google's at 600, my calls expire worthless, my puts are worthless, and I keep this $59.25. So ideally, what we want to do is we want to go up and we want to hold this collar for as long as possible without jeopardizing ourselves and a move to the downside. Of course, we certainly expect to blast through that 572 level. And one thing I want to do is, here's I put a trend channel. We want to monitor and see if we stay within the channel or go beyond the channel. So I put in this trend channel. And our strategy, strategy is to look for at least 600. And if we blast through there, maybe 629. And then we'll see where we are in terms of time. If there's a lot of time left, we'll have to close out the collar, and we won't actually achieve our maximum, but we'll still have a decent profit on this. So let's, all right, we've moved forward in time. And right now it's October 25th, 2007. And we've gone through 600. We're at 610. We've also go through the channel. So we might be doing a throw over here, which means we may be seeing a reversal soon. But we'll still hold it longer. Remember, with the short calls, we're earning the time decay on those. We want to wait as long as we can stand it. and so we'll hold this. All right, we've gone further. We're now up to 678. We've gone way beyond what we expected. We sold calls at 600. We can't make any more in terms of intrinsic value. All we can hope for is that maybe this will go sideways for a while and we can just put in some time. But this concern here, way over this trend line, over the channel, this could be a big throwover. The larger the throwover, the more violent the reversal. We don't want to give up our profits here. So let's just see how far can this go. Well, here's another, using that Fibonacci guideline of how wave 4 can divide the entire price range. What we see here is that if wave 5 ends at 721, the end of wave 4 will have created a golden section, 0.382, 0.618. So it looks like there's a potential here to even go up to into the 700s. So we'll hold it a little bit longer. All right, we've blasted through here. We've gone up now to 747.24. That's the high here. Here was that we were looking at 721. This is a dangerous situation here. We have a big throwover, and we have this reversal on the weekly bar. Higher high, lower low, closed down. I don't know what you think, but I think it's time to get out. I'd like to wait longer. I know it's you know, we're going to have to buy those calls back and close out the position. We'll sell the puts and we'll sell this long position, but we should still have a decent profit. So we're going to close this out. And we're closing on November 9th, 07. We're selling Google at 663.97. We have a profit of 138.82. We're going to close the calls out. We're going to buy the calls back. We're going to sell the puts. Now I'll get back to that. We have a net cost of net 92. The implied vol went up somewhat to 37%. That was actually that's on the front contract. The March at the monies were way up there at 40%. The total net profit on the collar was $30.92. The tricky part here is, you know, why did I sell the puts? Why not hold the puts and wait for the down move? And like we did with the previous example, make it on both legs. Well, in this situation, the puts still had a decent value, even though we went way up. There was still 1/3 of the original value. The puts cost us $32, almost $10 less. That's 1/3. That's decent. Secondly, by selling the puts, that increased our total net profit by 50%. Otherwise, we would have only been left with $20 and the risk on the puts. And remember, the original purpose of the puts was for protection. It wasn't a spec. So now, granted, this looks like a reversal, like we're going to go down and so on. But when you put it all together, we probably should just take our $31 and walk away in this situation. On the next scenario, you'll see where we don't do this, but we shouldn't give this $10 up. I mean, that's pretty decent. And not only that, if we're going to go down, maybe we wait for a pullback to the upside and then do something there. Well, okay, here's what happened. Yeah, it did collapse very quickly, and I know what you're thinking. Yeah, you should have held the puts. Well, yeah, but you would have to sweat it. Those puts didn't really get in the money till we came down here in February, around end of February 2008, somewhere in February. So you would have to sweat it out. And like I said, you did get that pullback here. And actually, Google made a beautiful move to the downside. I just showed, this is only up to March 22nd, 2008. I just wanted to show you what happened. If you had kept it to expiration, you would have done pretty well. But at the time, look, this could have put in a lot of time before it went down. And remember, individual stocks don't have to necessarily follow your forecast on the indexes, right? Individual stocks do have their own wave counts. Let's go to the next example, third scenario. continuation of the long-term trend, or a swift and major reversal. This is a situation. You're right here. You've done primary waves 1, 2, 3, 4. You're in 5. You're way up there. Like, let's say, like oil is a good example. And you want to do something here, but it's tough. Like, the market's going way up. It's, let's say, very bullish. But you know you're in uncharted territory. You could have a reversal at any time. But on the other hand, each new fifth wave might subdivide into another extended fifth. So we're talking about a situation where there's the potential for a major move. I'm talking now really high degree. Major move in either direction, major turning point. So what do? We do a long straddle. A long straddle is where you buy an at-the-money call and you buy an at-the-money put, and you're positioned to go either way. It's expensive. You have a net debit. You're buying right at the money. You're paying top dollar. That's why you only do this in a situation where you're at a major turning point and you can go up or down in a big way. Otherwise, it's not worth the cost. The close cousin to the straddle is the long strangle. It's the same thing, except instead of buying at the money, you buy a little bit out of the money. It costs less. Maybe you have more uncertainty. I'm not going to get into the strangle. If you have questions on it, you can send them in. We'll just deal with the straddle. And here are the characteristics. We buy at the money call, at the money put. It's a cost, a heavy cost, but we're looking for a significant move in either direction. Relatively longer term strategy, about 3 months. You can't go too long because it's so expensive, but you can't go too short because you're paying the net debit, and you got to give yourself time for this to unfold. Your maximum risk is capped at the net debit cost. Your maximum reward is uncapped, and you have 2 break-evens because you're positioned for either move up or down. You have a break-even up and a break-even down, which is the strike price. They're both at the same strike, plus the net debit or minus the net debit if you're going to the downside. From an Elliott wave characteristics perspective, we're talking about the main trend, either continuation or major reversal potential, impulse wave, major turning point. Maybe you're going to turn down into wave 1 or continue up in wave 5. High degree, you're going to enter at what you think might be the end of wave 5. A wave prior to entry at next lower degree is impulse. And here's just a checklist here. I won't go through all this, but you should do a certain amount of Fibonacci analysis with respect to price and time. And you'd like favorable implied volatility at the entry point. If you're going to buy at the monies here and put in a call, you don't want a high implied vol. That's going to make it even more expensive, which means that your forecast has to be for even a bigger move to make it worthwhile to do that. We don't have time tonight to talk about Fibonacci time targets. If you're interested in that, the Fibonacci course that we have covers that. And actually, in these examples that we're covering tonight, I couldn't even find a Fibonacci time cluster, so it wasn't worth going through the analysis. So let's look at an example. Here's soybeans. This is a chart of soybeans, and we're going to start counting from this August 2007 low. Soybeans, as quoted in U.S. cents per bushel. And the ticks are a quarter point on futures, and which is a quarter of a cent. 1 point equals 1 cent, which is $50 a contract. And this, we're starting here. This is February 6, 2008, where soybeans closed at $13.39. The range was $13.92 to $13.32. So I'm counting this from the low, and I can count waves 1, 2, 3, 4, and then 5. But I put a question mark. What's the question? Well, the question is this primary wave 5 here in blue, is it over? Are we going to go skyrocketing up? Remember, this is a commodity. And commodities, it's common for the fifth wave to be the extended wave. This wave 3 It's certainly a lot longer than 1. It doesn't have big subdivisions that you would expect in an extension, so somewhat debatable. What we're going to do, though, to do the straddle, we have to build a case for the big upside and a big downside. Otherwise, it's not worth it. We want to see if we can build a case for either side. I put in a trend channel, and we see that there's certainly room in the trend channel to the upside. So that certainly argues for that. And using my Fibonacci analysis, I'm looking at if this wave 5 ends at 1577, wave 4 will have divided the entire price range into 2 equal parts. It's a Fibonacci guideline. So that's one potential target is 1577, which is about a good 200 points above where we'll do this straddle. If wave 5 is equal to 0.618 times the net distance traveled of waves 1 through 3, it would equal 1530. So we have 1577 and 1530 as potential targets to the upside. And here, okay, now here's an argument that wave 5 might be over, and we're going to get a big reversal. If wave 5 ends at 1435, the end of wave 4 will have divided the entire price range into the golden section of Fibonacci 0.618 and 0.382. That's an argument that this thing is almost over, and we're going to go down in a big reversal. Okay, that's good to know. Also, if wave 5 equals 0.382 times the net distance traveled of waves 1 through 3, that happens at 1407. Well, you know, we're almost there. We've almost reached that point. So that's an argument that we're going to turn down. Well, if we're going to turn down, how far are we going to go down? We have to know that, because we're going to have to compare that to the premium that we're paying. Well, in the information I have here, we're not quite sure whether this whole 1, 2, 3, 4, and 5, is that at the next higher degree, is that a third wave, a first wave, a fifth wave? Well, the most conservative would be it's a third, and you're going to go into 4, which means you would at least go to 1180. So we have 1180, but we may make a 50% retracement at 1114. And by the way, these carrots, soybeans, beyond 1 cent, it's quoted in either quarter, halves, or 3/4. So 4 means a half, 2 means a quarter, this 6 means 3/4. So 1180, maybe even 1114 to the downside. That gives us objectives there. But let's look at a longer term. This is a weekly bar chart. And by the way, we were, I should have mentioned before, let me just go back. We're looking, this is the May 2008 futures contract, okay, on the daily chart. But we're going to go to the weekly continuation chart. Remember I said maybe this is a 3, well maybe it could even be some kind of extended fifth wave. There's a number of ways to count this. I mean, we could count 1 up to here where I'm pointing, 2, and then 3. So we are going into 4, which would mean we go down to maybe 1180. But there's an alternate count here that's very interesting. Actually, there were a couple of ways to count. Let me go back. We could count 1, 2, 3, or maybe just 1, 2, 3. In either case, it could be the end of a 3. These 5 waves could be part of a 3, which means we're going to make a shallow retracement. But here's an interesting alternate count. We could also count this as 1, 2, 3, 4, an extended 5. Of this whole move, the 382 comes down to 1172, 50% comes down to 1048. That's on the continuation chart. But what's interesting is we know with a fifth wave extension, if this truly is a fifth wave extension, you normally come back down to the area of that after the second wave, where you did the 1, 2, somewhere in this area over here, after finishing wave 2 and starting up, where the extension actually started to kick in, which is around this 1048 and 3/4 level. So we have some pretty good downside targets. This is what we're looking at. We're looking at this potential. On the upside, 1577, maybe 1530 first, then 1577. On the downside, 1180, 1114, and maybe even 1050 if this is the end of a fifth wave extension. So based on that, we're going to look at what it's going to cost us to do this straddle and where our break-evens are and so on. Well, in this case, some bad news. Look where we are here. Here's a chart of the implied vol over the past year in soybeans. This is the front contract. If we buy this straddle right now, the vol is pretty high. It's going to be expensive. And as I was working through this, I'll tell you, I had a lot of trouble trying to find something that would be consistent with the forecast that would give us some decent risk-reward ratios on this. And what I found is there was a little bit of way of getting around this cost. We can do the straddle. We can go long the straddle on February 6, 2008. What we're going to do is, if we go out 3 months, which is usually about what you would do, it was so costly that it just wasn't consistent with these targets. Yeah, it was still possible to make a profit, but the maximum risk versus your potential reward just wasn't there. But what I found was if I went to April 2008, the Aprils expire March 20, so it's a little bit under 2 months. I could buy the remember this was dealing at 1339. I could buy the at the monies, which I made 1340. I could buy the 1340 calls at 60, and I could buy the 1340 puts at 61. That's a total cost of 121 points. It's expensive. Keep in mind, it's $50 a point here. The implied vol on the April contract was 33%, and as you see from historical, the historics are on the front contract, but still, it's pretty high. But what I did is the trade-off here is I bought less time because of the expense, and what I found is if I did that, and I looked at my break-evens, here are my break-evens. My break-even to the upside ended up at 1461, and my price target's 1577. So my potential reward to the upside is 116, almost equal to this net debit. I mean, I certainly would like it to be greater, but it's not bad. Keep in mind, we're looking for a big move in either direction. We just don't want to go sideways. Break even to the downside is 1219. Well, I'm looking for at least 1180, so that gives me 39 points. But if we get these other targets, of course, I have bigger potential. So I felt with this kind of situation, it was worth doing the straddle. And so let's move forward and see what happened. Okay, we moved up. We've gone through the trend line. We're now up to 1485. So it looks like the big move was still to the upside, continuation of the main trend. So we're going to continue to hold this until we get to our objective. So let's move forward again, and that was it's now February 25th, 2008. We'll go forward again. It is now March 3rd, 2008. We're getting close to expiration. We got to do something soon here. We met our objective. We got to 1586, beyond the 1577. But what's most important here is we only have 3 weeks left. So I would certainly recommend getting out here. What we're going to do is we're going to close out the calls on March 3rd, 2008. We'll sell the calls, and we can sell them for a nice profit. We're going to sell the calls at 222.25. That's a profit of 101 points, 101 and a quarter. Remember, we bought them at 60. The vol actually went up a lot, so that went up to 42%. And again, on the April contract, the big question here, just like with Google, well, what do we do with the puts now? Well, the puts are only worth 2 points. Actually, it's 2 3/4 points. So unlike Google, in this case, we're going to hold those puts. They're not worth selling. And we're going to hold them for several reasons. First, we have a nice big net profit. By selling the puts and getting 2 more points, percentage-wise, doesn't increase our profit very much. The value of the puts is low. Now, granted, money's money, and 2 more points is 2 more points. But remember what our original purpose was. We felt there could be a sharp move in either direction and that wave 5 might be over. Well, if we felt there could be a sharp move down over here where I'm pointing, we certainly must still believe way up here that there also could be a sharp move down. And our whole orientation was that at some point or another, this 5th wave is going to end and there's going to be a big reversal. So these are all good arguments to hold the puts. We're not really giving up much. It's only another 2¼ points. And that's exactly what we're going to do. But we have one little problem. We only have about 3 weeks left. But it's worth it to do that. So we hold the puts that we have. And we can also make some new projections on the downside. Now that we've come up here, we have to recalculate the retracement. The 382 comes into 1300, and our puts are at 1340. The 50% is at 1211. And if we look at the continuation chart here, the long term, the 382, just a 382 comes down to that 10, it's 1049 3/4, 1050 level, right in this area here, or where that extension began. So we have a shot. So let's see what happens here. Well, in fact, it did make this a violent reversal, consistent with the throwover. I forgot to mention here we had that throwover, and this is a case where we just hold the puts to expiration. And on March 20th, 2008, the puts expired, and we came down to this 1207 level, well below our 1340. So on March 20th, 08, the April 1340 puts expire in the money at 1333 over here. I'm sorry, at 133. The 1340 puts expire in the money at 133. So we had a nice profit, a total net profit of 234¼ points. And if you want to see just what happened after that, it did make a big rally later after that, after reaching it. It actually got down to 1106. Remember we were looking for those, 1114 and 1050. It really did get down there. So this is a case with the straddle where, now if for some strange reason those puts had some decent value, then we might have sold them. But they didn't, and we had a nice profit anyway. It was worth holding them all the way to expiration. Okay, 4th scenario. Sideways market. You start down in wave 1, you go up in wave 2, we come down in wave 3, we do a little zigzag, we call that wave A, we got another zigzag, wave B. Let's say you've been trading this, you've been shorting it, you've been going long, you get stopped, you're going back and forth, you're really frustrated, it seems directionless, so what do? Well, you don't have to give up. What we can do is do what's called the long iron butterfly. And we do this if we feel that we're in the middle of a triangle. With the long iron butterfly, you're looking for a sideways move. You're selling the at-the-money puts and calls. You're earning the premium, and you're looking to earn the time decay. You're looking for just a short-term sideways move. You buy an out-of-the-money call and an out-of-the-money put, all 1-to-1 for protection. So if you do get a big move, if you're wrong, you're protected. It's a net credit. In this case, you have a cash inflow. You actually have revenue coming in. And as long as the market goes sideways and ends about where you did the at-the-monies, you collect the net credit. And here are the characteristics of setting this up in the long iron butterfly. as I mentioned before, you sell an at-the-money call, an at-the-money put. You buy it out of the money call, buy it out of the money put. It's a net credit. You're market neutral. This is a relatively short-term strategy, about 1 month. Maximum risk is capped at the difference in adjacent put or call strikes minus the net credit, and the maximum reward is capped at the net credit. You're not going to earn any more than that net credit that you took in. So it's a matter of structuring it with your break-evens and so on and managing it. You have 2 break-evens. You have an upper break-even and a lower break-even. The short call strike plus the net credit, and the short put strike minus the net credit to the downside. So when do we do these? From an Elliott wave characteristics point of view, these are for counter trend moves, contracting triangle and barrier triangle. This is the opposite of the short iron butterfly. You don't want the market to move anywhere. Ideally, it would just be straight line right at your strikes on your short call, short put. Excuse me. I'm just going to have a little water here. It is water, I guarantee. What wave position? Wave 4 of an impulse, or B of a zigzag, X or Y and Z. The degree relatively low. Entry point, the end of wave C. After that C wave where you're coming down and it really looks like it's going to be a triangle, that's when you want to do this trade. So you capture waves D and E. So here's the wave prior to entry, maybe an impulse or a diagonal, the C of the C wave, just to confirm that it's over. So let's look at an example. We're going to come back to coffee. Remember, here's where we were. This was that expanded flat in here that we were trading. And what happened was coffee came down in this downtrend. So I've labeled it, here's 1, 2. We've made wave 3 down. We have a 3-wave A, a 3-wave B, looks like a 3-wave C, and I have a question mark. This is the March 2009 contract in coffee. These are the daily bars. And it's all sessions combined. This is, we're in November 5th, 2008 is the most recent bar on this chart. And what we're going to do is, the question is, well, is this a triangle or is this maybe going to be an expanded flat? We're not sure. What we'd like to do is see another move down, because maybe this is a C wave, maybe this is going to make 5 up waves and go way up. So we want to see more confirmation. And I've moved ahead now. It's now November 6th. This is November 6th. And coffee's at 115.55. And now it does look like more of a triangle, because this C wave doesn't look like a 5-wave structure. We've come so far down here, it's leaving behind 3 waves. So it looks like we have a 3, 3, 3, and possibly we're going into wave D. So what we'll do is we'll put some trend lines in here, so that we can monitor this. We can monitor the triangle and see if hopefully it'll put in some time. We're going to again do the long iron. I almost said long iron butterfly. Just a few things here. Just looking at the retracement here so far. That this A wave over here made a very shallow retracement of 3. It was even below the 382, but that might be good. Maybe that's because of that. Maybe this will put in time and go sideways to try to meet the trend channel line. So let's look at that. We'll look at the trend channel line, and here's our expectation that we're looking to go down in D and up in E and use up a lot of time. And here are the key levels here. We know in the triangle that wave D should not go beyond B. B's at 110.10. And the E wave should not go beyond this C wave, which is at 123.35. One last thing we check before we do this. Again, we got to check the vol, the implied vol. And this actually works out to our favor. This is the implied vol on the front contract in coffee from January, the beginning of the year, to November 6, 2008. And it's high. You can see relative over the past year. That's basically good for us. I mean, we're selling at the money, so we want to get as much juice out of this as possible. On the other hand, it could spill over to the out of the money buy options for our protection. So we'll have to see how that works out. But still nothing here to stop us from doing this trade. So here it is. I'm doing the long iron butterfly. What do? Remember I said coffee right now over here is trading around 115. I'm selling the 115 calls, the 115 puts. Everything's 1-to-1, one of each. And I'm getting 585 on my calls, 501 on my puts. And then for protection, I'm buying some out-of-the-money calls and some out-of-the-money puts. Notice where I'm buying them, a little bit outside the triangle. 125 on the upside, and on the downside, 105. What I did, what I'm trying to do here is the key of these break-evens. I certainly need protection in case I'm wrong. But in this case, I'm trying to buy my protection as cheaply as possible to push my break-evens out. Because what I don't want to happen, if I have a tight band on my break-even, what I don't want to happen is that at expiration, I end up in the triangle as I predicted, but my break-evens were so tight, I lost money. So I want to make sure that these break-evens are as far out as possible, preferably beyond these levels here, because beyond those levels, the triangle would be invalid. But as long as the triangle is valid, I'm going to be between these two levels. And I had to work out the numbers. You can use some option programs that help you calculate these various things, but I just looked at it, and just through a quick trial and error, I was able to create a break-even outside this level here of 110, but this break-even was 122, pretty close to the 123. And I ended up with a net credit of 7.14. So put another way, I was able to put my protection at the outer ends of the triangle and create break-evens that basically covered the whole width, not the width, but the maximum extremes of the triangle. And if I can hold this, I did it for 1 month. These were the January 09 options that expired on December 12th, which is so 1 month, about 1 month away. You do these short term. The vol was on the January contract. The vol was 37.5. And we do these short because you don't want to give the market a chance to basically make some kind of violent move. You have to give them short, and you're earning the time decay, which is at its maximum 1 month and less in terms of the acceleration. So that's the trade. My maximum risk was 286, and my maximum reward was 714. So not a bad ratio in terms of risk reward. Let's move forward. Okay, we've come down, and we're still in the triangle. It's November 25th, 2008, and we'll still hold on to this and see if we can use up time. We want to hold on to it for as long as possible. I put in my AC and BD trend lines to monitor the contraction. Another thing I can do, Fibonacci relationship down here, way down here, because I had no other place to put it. Fibonacci relationship in triangles. Alternate legs of the triangle are often related to each other by the Fibonacci ratio of 0.618. Oh, notice here I decided that this might be the end of wave D, 110.60. This is 110.10. And I'm looking now for the end of wave E. The relationship, wave E, Fibonacci relationship is that it would be equal to 0.618 times the length of wave C. That comes out at 118.80. So if wave E ends at 118.80, which is within the triangle, remember this E wave should not go beyond this 123.35. If wave E ends there, it will have equaled 0.618 times C. So I'm going to look for that. We'll go forward. And we're now up to December 1st. And we've actually got up to this high here was 117.5. But excuse me, but we're running out of time, and this is going to, which is good. We want this to go sideways as long as possible. But on the other hand, we don't want to risk this breaking out of the triangle and going to the downside. And we see here, here's a couple of scenarios. It's possible wave E ended here with a failure in the C of E, or maybe wave E is going to make a triangle within the triangle. That's what I'm trying to show here. So these are the possibilities. But what we're going to do then, we only have about 11 days left. And if this truly is wave E here, it's going to make a sharp move to the downside, and we could lose our profit on this. So we're going to get out. We're going to close out on December 1st. Let's take a drink of water here. Sorry. We'll close out on December 1st, and we'll buy back the calls and puts, and we'll sell the long calls and puts. That was a net debit of $530, and remember it cost us $714. So we had a net profit of $184. We didn't achieve our maximum, but there was still a lot of time left, and we couldn't afford to wait another 11 days or so. We run the risk of blasting out of that triangle and losing everything in terms of our profit. And here's the result. It did actually go down. For wave 5 over here was a small wave 5. By the way, I just showed the implied vol over here. And then there was a rally upward. Okay. This is one of my favorites. This scenario, a question or a number of questions. Deeper correction, sideways, or continuation of the main trend? Kind of makes you dizzy just looking at it. But it's a situation I think that we all encounter often in trading. And here's the example. Let's say we come down in wave 1, we go up in wave 2, and we come down in wave 3. And then we go up in wave 4, and this could also be in an uptrend. And you're here, and maybe wave 4 was very shallow. But let's say it's a big downtrend, and you really want to go short. You really want to short this thing, but you're concerned because maybe wave 4 isn't over and it's going to go up, or maybe wave 4 is going to go sideways. But it also has the potential to go down. So you have all these scenarios. You have basically 3 scenarios, and you don't know what to do. And now, granted, you could go short, get stopped, go short, get stopped. You know the routine. Well, there's an option strategy that can help you deal with this situation. It's not free. It's not 100%. It doesn't mean that 100% it's going to guarantee you anything. There are no guarantees, but it's useful, and it's called the bull put ladder. And the bull put ladder is what you do If you're really bearish, and there's a bullish one too, that's called the bear call ladder. I'll show that on the next slide. You're really bearish, but you're really nervous because maybe it's the end of the trend. You don't want to get whipsawed. So what you do is you sell an at-the-money put, and you use that revenue to cover buying an out-of-the-money put and a further out-of-the-money put. And by doing that, this is what you have a net credit. So you actually, when you start the trade, you actually have a revenue coming in, a cash flow coming in. And what you've accomplished is if the market goes up, you keep your credit during the time, let's say on or before or during the time out to expiration, you keep the credit and you walk away. If the market goes sideways at about where you sold your puts, same thing. You keep your credit, walk away. If the market collapses, you have these puts. So where can you lose? Right in here, between these two. Where you lose is if there's actually four scenarios. The losing scenario is if you only go down a little bit. If you end up between these two strikes, you're going to lose money. That's the sacrifice. That's the trade-off. What you're doing is you're giving up the a small move to the downside to either cash in a big move to the downside or walk away with your net credit to the upside or sideways. That's how the bull put ladder works. Or if it's to the upside, the bear call ladder, same thing. It's just, here's a diagram just going to the upside. Okay, so again, if I go back to the, we'll just look at the bull put ladder again, just to make sure this is clear. We sell an at-the-money put, and we use that revenue to finance our out-of-the-money puts, and hopefully have a little bit left over. That's all we want. It's just a little bit left over, so that we make money here, we make money here, and if we have a big move down, we make money. But our exposure is in between these two because we've shorted the put. So until our protection kicks in, we're going to lose money in that situation. But covering 3 out of 4 scenarios isn't bad. And here are the characteristics. Here's the setup we went over. In the bull put ladder, you're basically bearish, but like I said, you're bearish, but you're nervous. You try to go 3 to 6 months. Maximum risk is capped at the difference of the first 2 strikes minus the net credit. Maximum reward uncapped. And you have 2 break-evens. As you're going down, first you do have that net credit, so you have the short put strike minus the net credit. And then your losses will kick in, but so you have another break-even to cover those at your lower strike, the lower put strike. When do you do these from an Elliott wave perspective? We're talking about actionary waves, the main trend, impulse waves, maybe waves 1, 3, or 5, a high degree. I'd say more waves 3 and 5 than 1 because with wave 1 you don't know. Wave 1 is more for the straddle, but I threw it in here anyway, especially if you have a key reversal. You might use it for that, but really it's for mainly 3s and 5s. But look at what I said here. For waves 3 and 5, after a shallow 2 and 4, due to possible flat or middle of wave 4 triangle, i.e. wherever there's ambiguity as to whether the correction is ended. That's what this is helping you with. So let's look at an example, and this is the last one. I'm sorry we're running a little bit long here. This is the British pound. This is a weekly continuation chart. And we're starting out down here. The actual day is December 3rd, 2008. And we can count on 1, 2. This is a bit unusual, 2. It failed to make a new high, but that was a quirk in the continuation chart. What happened was we were switching from the June to the September. Here's the September contract, and that looks a more clear, gives you a more clear wave count, 1 with a more normal 2. So I just wanted to point that out. And now what I'm doing is I'm coming down. Let me just step back. I'm going to blow up this area and go down to the daily. This is a daily bar chart on the continuation chart. And we're going to put in a wave count here. And this was during that time the pound's collapsing, and this was minor wave. That was that 2 that you saw, that minor wave 2. And you have 1, 2, 3, 4, and now we're in 5. And it's December 3rd, 2008, where the pound closed. This is the British pound against the U.S. dollar. It closed at 147.80. And the situation is as follows. The pound's collapsing. You're really bearish, and you want to get on the bandwagon and short it. But there's a little bit of a problem here. This wave 4, look how shallow this wave 4 is. That means maybe it's not over. Maybe we're going to go back up. Maybe some kind of expanded flat. There's danger there. Or maybe we go sideways. So on the one hand, on one side of your brain saying, hey, let's go short big time. Let's load up the truck from the short side. But then the other side of your brain is saying, whoa, wait a minute. There's a problem here. Can we just talk about this for a little bit? And you're really stuck here. So what are we going to do to solve this? We do the bull put ladder, which gives us a stake if the pound's going to really collapse in another big 5th wave. After all, this 3rd wave, it's longer than 1, but it's not really extended. It doesn't have the really big subdivisions. That means this 5th wave could be huge. This first wave was 26 cents. And this 3rd wave was about 41 cents. So it's about 1.58 to 1. The pound could go to par at this point. It's so bearish. But here's the danger we're talking about. This 4, it didn't even come close to making a 0.382 retracement of this 3rd wave over here. That's a problem. So what are the different scenarios? Here's the first scenario. This is, of course, what we really want. We want to go way down in wave 5. But the other side of our mind is saying, no, 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 look what could happen here. We may go way up and finish 4 up here and then go down in 5. That's a problem. Or we may make a triangle, go sideways and maybe get chopped up. That's another problem. Then, of course, we may just, I didn't put it in here, now, of course, the other scenarios, we just go down a little bit. But we can cover 3 out of the 4, as I explained before, with the bull put ladder. And what we need to do before we construct it is we need to know, okay, well, how far can the pound go down? So we're going to do some Fibonacci analysis here. I'm looking at the net distance traveled of waves 1 through 3, right? I'm starting here, I'm ending here, I'm expanding from here. Well, the 0.382 times 1 through 3 is 134.20. Well, that's not too far down. Let's look at some other possibilities. If wave 5 ends at 127, the end of wave 4 forms a golden section, 0.618, 0.382. Well, now we're getting somewhere. 127. Remember, right now we're at about 147, 148 in that range. So that's a good move to look for. Over here, if wave 5 equals 0.618 times the net distance traveled of waves 1 through 3, we can go down to 121. And as a matter of fact, if we go down to 121, that wouldn't even be an extension. It would be shorter than 3, but longer than 1. So that looks pretty decent. 1, 2, 3, 4, 5. It looks all pretty much in proportion. So we'll use the 121. But here's a problem. The vol is high. This is a chart of the implied volatility on the front contract in the British pound. And although that may help us in shorting the at-the-money puts, it could also hurt us in buying the out-of-the-money puts. So we have to see how those numbers come out. So let's do it. We're going to do the bull put ladder back on the daily continuation chart. We're going to do it on December 3rd. And what we're going to do is we're going to do the February 09 options that expire in February 06. So we have a good 2 months. I tried going out 3 months, but it was very expensive. Those puts, it was really tough trying to buy the puts and then finance it with the short at-the-money put. But given our targets, this was not too bad. I was able to buy I was able to sell the 149 puts, which were a little bit in the money at 672. Buy these 140 puts, the 137 puts, and I was able to actually generate a net credit of 123 points. So the maximum risk that we can lose is 777 points. It's a lot, but our maximum potential reward was 806 points. That's based on a target of 121. Our break-even is 129. First break-even was 147 because of the net credit, and then 129 going down. So, and it's now December 3rd. So let's see what happens. We've moved forward. Okay. Our worst case scenario, our worst nightmare may be unfolding here, but we're protected. It looks like we're starting to move up. We went through this trend line. It's December 8th, and we're trading at 149.20. That's not good. With this type of strategy and what we did, if we don't get a sharp move to the downside almost immediately, we have to look to get out. Because to save money, I didn't go out very far. I only went out 2 months instead of the normal 3. And if this really is so bearish, we should get the sharp move down. If we don't get it, we don't have much time left. We can't sit on this. Remember, if the pound goes down slowly and ends up between 149 and 140, we lose money. And we lose a lot of money if it just goes to 140 and stops there. But of course, we had a lot of targets beyond 140. So let's see. Let's go to the next. Okay, we've come way up here. We're at 157, and it's December 17th. We have 1.5 months left. Well, this was one of the scenarios. We were prepared for this. We have a net credit. We're going to close this out. We just can't wait for that big move to the downside. And that's what I've done here on December 17th. I've bought back the short puts and sold the long puts, and there was a net debit of 99 points, but I had a net credit of 123, so I squeezed out a profit of 24 points. But the bull put ladder served its purpose. We didn't want the up move, we didn't want the sideways move, but we didn't get that big move to the downside, so we get out. And the reason we didn't achieve the whole 123 points is there was still a lot of time left. Let's see what happened after that. Okay, this is what actually took place. We actually had a small 5 over here. And there was, we got out in the end, we actually got out at the top of this A wave on December 17th. And if you're wondering, well, what happened if we had held this to expiration? The expiration was right over here, February 6th. And it expired at, it was around 147.80, so we might have done, squeezed out a few ticks, but we couldn't take the chance of this maybe breaking out further to the upside and ending up somewhere in that 140 range. Okay, that concludes the end of this webinar. I put in a summary sheet here showing you the different scenarios, the market situation. It's kind of a quick reference guide. And what I want to do now is I want to open things up for questions. And what I'll do is I'll wait a few seconds. And see, I'm going to check the Q&A blog and see if we have some questions here. I'll just give it a few seconds. Okay, one question that has come in from Dave. Dave is asking, what could go wrong besides the market not cooperating in these strategies? It's an excellent question. One of the things that could go wrong is, and I didn't discuss this, the bid-offer spread. Depending on the market and the bid-offer spread, when you work through the numbers, it may not work out, especially when you're in that bull-put ladder where you're trying to squeeze out a net credit for yourself, or even in the collar. Although the collar probably would still work out, but it would cut down on your potential. But yeah, on that bull put ladder or some of these other strategies, yeah, I didn't get into that. But bid offer spread is important, so it's not going to be always so easy. Okay, let's see. Kent is asking, in the second scenario in Google chart, why would you not be called out of your March 08 600 call on the price? Yeah, good point. I didn't get into the fact that, yeah, you could be exercised. When Google passed through, we were short the 600 calls, and when Google passed through 600, you're right, you had the risk that you would be exercised. Well, actually, that would be good because then you don't have to pay the time. There was a lot of time value left. You can be exercised, but remember that a lot of people wouldn't exercise you because they're on the opposite side, and if they exercise you, they're losing out on the time value. It's better to sell if you're long. If you're long the option, and you have a lot of time left, and it's in the money, you're better off just selling the option and getting some time value as opposed to exercising. So yes. If I had been exercised, that would have spared me the agony of continuing to wonder how long I could hold them, and it would have made it easier, actually, if I had been exercised. And then I could have decided then what to do with the puts. So that's a good question, a good point. Okay, Steve has asked, what's the best way to determine which long strikes to choose on the bull put ladder? How wide should they be from the short strike in general? Great question. You have to play with the numbers. You first have to have your forecast of how far you believe that market can go to determine what your potential profit's going to be. Then you have to see, well, okay, if I sell the at the monies, I have so much revenue to work with. And then you have to start either by trial and error, or I think there's some option calculators that can help you work out the numbers. You start looking at strikes, and it's just a matter of, it's a trade-off. The further down you buy your puts, or the further up you buy your calls, it's cheaper. But remember, then you're increasing that area where you can lose. Right? The first put, if you're going to the downside, that first put that you buy, that's your stop, basically. The further down you go, you save money, but then your potential loss goes up. The further up you go on that put, well, your potential loss goes down, but then it costs you money. So it's a give and take, and what kind of risk and reward you feel you can live with. There's no specific guideline. You just have to see, what the potential is to the downside and whether it's worth it to take that risk. But you can manage that risk too, like we did in the example. We didn't wait around to see if this was going to go down small. We were looking for a huge collapse, and it didn't happen. It went the other way. So you can actually manage that possibility. Okay, next question. Are these also the best strategies for the stock indexes or commodities, since fifth wave is usually the extended wave in commodities? Well, in general, these strategies, I felt they were the best for those situations. And so they're not limited to any particular market. They may work better in some other markets, but they're situation-based with respect to the situation as defined by the Elliott wave patterns that I identified. I wouldn't necessarily say no, that one strategy only works better for commodities and so on and so forth. Now, granted, a commodity normally has a fifth wave extension. If it's at a high degree, could be a great opportunity for straddle. Okay. Next question. On slide 31, why didn't you count the first two waves on the Google chart? Could they be wave 1 and 2? Well, let me go there. Let me just see. Okay, here's slide 31. Oh, over here. I assume you're talking about this price action. Before that, it's not clear. It's not clear what this is. Remember, Google was an IPO, and if you look at the price action from the inception of the IPO up to this high, I assume you're talking about why isn't this a 1, 2? Is that? Could you come back on the chat and just? Is that what you're referring to? These first two waves over here? Just waiting for. Yeah, it's not clear what these are, but what seems to be clear is from this low, this major low, there was a clear count. So I didn't deal with this, and I didn't have to deal with this. I could see a nice wave count here that gave, and just based on the wave count off of this low, had great potential for the upside, no matter what this structure was. Okay, is that? Okay, let's see other questions. I know we're running late here. Okay, someone has asked, in the Google example, why not do a straddle? Well, because with the Google example, our analysis, we weren't looking for a big move in either direction. We were convinced it was going up. The Google situation was that we just didn't want to get stopped out. We didn't want to get shaken out. And the intraday moves were large, and if we set a low stop, well, and we're wrong, we were faced with a big potential loss. The straddle was not the correct structure there. We were looking for a move up, and we weren't really looking for a move down. But we were trying to find a way to buy some cheap protection and have a tighter stop or tighter protection with the put and keep us in the ball game, basically. Okay, let's see here. Other questions I'll take. Okay, another question. Okay, question is, what's the best strategy for a third wave? Well, third waves, of course, are the powerful waves, and we didn't cover that tonight in a third wave. But I would say if you really feel you're in a third wave at relatively high degree, a put ratio, well, if it's going down, put ratio back spread, or if it's going up, the call ratio back spread. These are similar to the ladders that we talked about. They're more aggressive. So if you're talking to the downside, you would sell an at-the-money put, and you'd buy 2 out of the money puts. It's aggressive. It's a net debit. Oh, you're not going to get a net credit out of that. So it's a situation where you want to be aggressive in a third wave. I'd say that's the answer. Oh, someone has asked, where can I download the PDFs? Yeah, there was when you logged in, there was a place to do that, but it's probably too late to do that now. We'll make the PDF will be available probably sometime early next week. So, or you can just contact customer service. Let's see, we have more questions coming in here. Okay, Scott has asked, which scenario do you use in your trading? Which scenario or which strategy? I think you mean which strategy or which... which scenario, which strategy? Yeah, strategy. It depends on the situation. I like a lot of the different spreads, and actually I didn't have time to get into it tonight, but some of these strategies are just combinations of spreads, meaning I guess for counter trend moves, I really like the bull call spread or the bear put spread for your second waves. And for the powerful moves, the ratio back spreads, put ratio back spread, call it, for some of these powerful moves in third waves. But if I can make the numbers work, I really like that bull put ladder, bear call ladder. If I can squeeze out a nice net credit for myself. Straddles, well, haven't used them that much because, you know, there's only certain situations where that works. They're expensive. And as a matter of fact, someone has, Darren has asked, on the long straddle, what if deep in the money puts and calls were bought instead with little or no premium for longer? Because, okay, this question from Darren is long straddle, what if deep in the money puts and calls were bought instead with little or no premium for longer time because of delta? Right, if you buy way deep in the money, you're basically not going to be paying much. For time value, yes, that's possible. The only issue with that is maybe return or yield. I mean, it's almost then basically like buying the futures, being able to kind of be long and short futures. And I'd say the only, yeah, that's another possibility. You have to look at yield then, or your return, right? Because you're spending a lot, but then you don't have the exposure to the time decay, nor to the implied volatility because you're so deep in the money. So, yeah, that is a possibility. Okay. Question from Scott: why do you not sell premium both sides, put and call? For what situation, Scott, are you referring to on that? Oh, any situation. Oh, well, I mean, if you're going short options, you have uncapped risk. So I would not recommend just selling puts and selling calls or both without some protection. No, you have unlimited or uncapped risk, and I don't think that's a good risk-reward situation. just to be short options. I think that's what I find is that's how most traders, option traders, go bankrupt basically. It seems to work for a while, but at some point when they get caught on that 8 standard deviation move or something like that, they get basically they're basically out. So no, I don't think you should just short options. No, absolutely not. Okay, there's some more questions. Someone has asked, what's the best strategy for a zigzag in wave 2? Well, the spreads, that's then your typical bull call spread or bear put spread, because those are great because you're talking about a limited move, and you're talking about, if it's wave 2, a sharp move that won't use up a lot of time, and you certainly don't want to use up a lot of time on that. Jeff has asked, could you have used a synthetic stock on the Google collar, i.e., buy a call, sell a put at both the same strike? Yeah, that's another way. Synthetics, I didn't get into that. Creating a synthetic long, I was approaching it from the assumption that maybe you already had the stock, or you wanted to buy the stock. So you'd have to look at the prices and the premiums for that, but that's a possibility. Let's see here. Okay, question is, what would be the strategy to participate in wave 3 when we are currently somewhere in wave B or wave C of wave 2? I'd say you're really talking. Well, let me draw it just to be safe. See if I have my. I normally have a whiteboard on these. No, I didn't get the whiteboard. Okay. Don't want to get out of this, so let me go back. Maybe I'll use this to draw, just so I can be sure. Okay, well, if we're currently somewhere in wave B or C of wave 2, all right, actually, I can probably not, I'll draw it anyway. So we're coming down, let's say, in wave 1, and we're in wave 2, so let's say that's A, B, and maybe even A, B, C. Yeah, that in this case to the downside, you a bull put ladder, just in case that C wave's going to go up like this. A bull put ladder in wave, if you're not sure that wave 2 is over and you could do more upside, or the bear call ladder if you're going in a bull trend. If you feel you've turned the corner, then the ratio back spread, put ratio back spread. But I think this is a good situation for the bull put ladder if you're not sure. Let's see here. Question is, where can I find a chart showing the premiums of options the day of and the day after the crash of '87? I don't know about a chart, but Bloomberg has very good historical data on options. It's like I think, like I mentioned during the presentation, it's all on a closed basis. You can't. I couldn't find intraday, but you could find it on a close. I think. I'm not sure if though if they go back to 87. That's the only thing, and that's one of the problems with showing these examples. It's sometimes hard to go way back. So I think your best source, either that or you'd have to go to some other chart service that would maybe look it up for you. Or you can go to the exchanges. You could probably get it off of the exchanges like the CME, but they would charge you for that. And well, of course, I'm assuming if you already have Bloomberg. I mean, of course, Bloomberg's charging you for the service, but if you already have Bloomberg, you can get it off there. You probably have to go back to the exchange. Okay. Scott has asked, if the market isn't going long, isn't the put your insurance? Don't understand the question. Could you maybe elaborate? I'm not quite sure what you're referring, or what situation you're referring to. Are you talking? Are we going back to shorting an option, shorting a put and shorting a call? Is that? I'm not sure if that's what you're referring to. Well, again, yeah, okay, okay. So Scott is asking if you sold both sides, meaning you sell a put and you sell a call. Well, you have uncapped risk. I mean, when you're short an option, it's the risk. I mean, you don't know for sure the market's going to go sideways, and that's why the long iron butterfly is constructed the way it is, because you have to have protection. Now, granted, it's for a limited time, but you can't take a chance. Like I said, that's how traders get wiped out. So if you're short a call and short a put, you have unlimited risk to the upside and the downside. It's not prudent. People do it, and a lot of them do it very short. Maybe they'll sell a week out, but it's still it's not. And some people make a living out of it. It's not the way I like to trade. Okay, anything else? And by the way, with the long iron butterfly, there are variations. There's the condor. The condor, instead of doing at the monies, you just push your strikes further out, and you have the condor. And there's certain situations that might be better for. So just to mention that. Any other questions? Anything else? Okay, keep in mind that it doesn't end here. You can send your questions into the Q&A forum after we're done. You can even attach, if it helps to clarify your question, you can attach a chart. I'll receive it, so if you want to point out something to me on a chart, you can do that. And when I answer your questions, I will post the question and the answer for everyone to see. And I can also post charts and send you back charts. If it warrants it, I don't necessarily do that all the time, but so there's a lot of flexibility. Okay, another question has come in from Jeff. Is the low implied volatility better for the iron butterflies? Well, it depends on which type. For the long, it depends on whether you're talking about the long iron butterfly or the short iron butterfly. On the long side, where you're selling the at the monies and you're buying the wings, the low volatility could hurt you because you're not getting that kick for the at the monies. But it also depends on on the skew, you know, the volatility curve, you know, as you move out further on the strikes, it could vary. But I would say generally, with the long butterfly, you probably want a high vol to get the big kick on the at the monies, but it really depends on how far out you're buying the out of the monies too. I mean, if you're not buying them too far out of the money, then you know it's a wash. And then on the short side, where you're buying the at the monies and selling the wings because you're expecting a sharp move, then you would want low volatility. And what's interesting is what I'm finding is a lot of times in these situations where it could be an expanded flat, you would think the volatility would be high, if you know, that everyone would be nervous. But most people aren't using Elliott waves, so they're not expecting a sharp move in either direction, like an Elliottician. And vice versa in the triangle, what I find is many times in the middle of a potential triangle, where you would think the implied vol would be low and that everyone's expecting a sideways move. No, it's high. It's like most of the market. It's as if most of the market doesn't know that it's going to go sideways, and they're all nervous about some big move. Which, from an Elliott wave point of view, there isn't going to be a big move, at least not for some time, relative to that degree. Okay. Other questions? All right. It's late. I'm sorry we ran so long. So if there's nothing else urgent, I think we'll end it here. And I want to thank you very much for hanging on for so long. There was a lot to go through. I hope you enjoyed it. Keep in mind we do have other option courses out there. And I think that wraps it up. Thanks very much. And again, I'll certainly will be ready for any questions that you want to send in.